Right, and this week we're reviewing the Foord International Trust. It was established in 1997, $1.1 billion in size. Cobie, take it away.
Yeah, I don't think we've ever looked at one of the Foord Asset Management unit trusts. This is called the Foord International Trust. And as a matter of fact, it's basically an equity fund, a global equity fund. If you look at your screen now, you'll see it's some of the factors that influence this fund. Formation date there, as Eleni said quite rightly, March 1997. Total fund size standing at about 1.1 billion, which is sizable for a South African asset manager managing global assets. MSCI World Equity, the total return index is the benchmark there, and then a very reasonable total expense ratio at about 1.36%. Certainly that should be something that South African investors should be looking at. What are some of the returns that you're seeing over there? Oh, 10-year return there, 7.8 relative to a benchmark return of 2.8. I mean, that's obviously where you kind of have to look at returns, is over the long term. And you see this fund having done so well. Foord being a deep value manager and trying to understand the intrinsic value of stocks and trying to obviously buy those at a discount. And you're just seeing those beautifully coming through over the long-term numbers. Just looking again at the rolling returns for the fund, you would have seen these over time that we've showed you these. The blue shaded area is the fund's relative return to its benchmark. And here you can see that playing itself out over time. That's relative to the MSCI World Equity Index. And if you want to see the MSCI World Equity Index, there you can see how it's actually performed. You see some really decent outperformance kind of in the beginning parts of where we're looking at the track record. Some underperformance, especially when you look at 2010. Returns that look quite similar to the benchmark, and then some outperformance at the latter part. And then just to show you what the fund looks like at the moment, you can see their equities predominantly in at 62% at the moment, cash at 31%, corporate, a little bit of corporate bonds and a little bit of commodity exposure. And obviously trying to see how they're going to deploy some of this cash into equities over time.
Well, I mean, 31% in cash, so that's quite a high portion there, yeah. Roland. But I mean, what's interesting, if you look at the equity sector allocation, consumer discretionary, consumer staples taking a large chunk, and so too industrials.
Yeah, I think this fund, if you look at the makeup, is very defensively positioned. And what I'm seeing here is that the manager is expecting a high inflation rate to come through globally, because the overweights are in sectors where these kind of companies can pass on higher prices and actually profit from that, rather than the sort of price takers. So he's got lots of luxury goods and these kind of stocks that tend to do well when inflation is doing well. So he's definitely pricing in some kind of inflation coming through, or a calamity globally coming through. You're also seeing...
Those are harsh words, I must say. A calamity coming through.
Well, if you've got 31% in cash for an equity fund, you are in a low yielding,
equities are looking expensive,
a very low yielding asset class. In fact, this is all in US cash, which is not exactly paying a high kind of interest rate. So clearly there is some kind of scaredness here, or fear to actually find stocks. Or manager clearly can't find enough stocks, but would you want an equity fund with 31% in cash?
Yeah, it's quite high actually.
I think the risk here is that the manager, relative to the benchmark, which is an equity index, is quite high. So the manager could do either really well or not.
And here we are, I mean, talking about international stocks offering far more value than what we see here in South Africa, and this is perhaps giving us a very different picture, Cobie.
Well, I mean, I spoke about consumer staples in the first part of the show, and here's a fund which is seeing those opportunities. Not only when I want to say that he's, as Roland quite rightly said about the inflation environment, but the other thing which is very important here is the fact that there's valuation on the side of many of these stocks. So remember that what this manager is trying to do is he's trying to say, how do I own businesses? What kind of businesses do I want to own? And am I paying a fair price for those? The market is going to give me that opportunity over time. How best do I incorporate those? Now at the moment, remember, 30% cash you can deploy very, very quickly in this fund. You know, if you've got $1 billion fund...
But surely markets are cheap now. Surely this is the time when you should be fully invested rather than having all your money. So
but you've just spoken about the Greek debt coming due in March, and various other things. So let's assume the Greek issue goes front burner again. So it goes off the back burner.
Well, that's my point.
And it goes on the front burner.
You've got a view here that things are not going to go as well in the short term, but then the fund manager is correctly positioned to deploy that cash.
And I mean, I think the other thing that's important here as well dollars. That Foord is a business which kind of manages around flexible asset, a flexible mandate. So they're kind of saying, well, how do I have the flexibility in order to deploy capital when I do see the opportunity? You know, you know, a catastrophe could happen during the year. You know, what kind of opportunity will you then have on the back end of a catastrophe? You certainly want cash in order to deploy within those kind of environments.
I mean, looking at a fund like this, does this also create fear in your mind when you see this?
Well, my view is that things are actually looking more positive, at least in terms of the European situation. The US is looking stronger. It's certainly our view that China is going to have a soft landing. So I wouldn't be as defensive as this manager is. But if you do believe that things are going pear-shaped, then this is clearly a fund that will position you correctly for that.
Yeah, I like the fund.
Okay.
I like what it does. I like the flexible asset allocation. The fact that you can own stocks for the long run. I think that those are kind of fundamentals. Those are things which appeal to me. I like owning businesses.
Okay, so I'm glad you're saying this, because now I can interrogate you further. Where have you been deploying capital recently, Cobie? Since you didn't answer before the break, and I'm sure the viewers are waiting in anticipation to hear. Fine, don't give me company names,
you
perhaps
know,
sectors.
As an investment team, I think late last year, and when I say late last year, the latter part of last year, the last quarter, we were deploying money globally and into equities. It's pointless owning bonds and cash because you're not picking up any yield for those, but certainly global equities was a favorite asset class. And if we want to talk about those, you can go and pick off the Morgan Stanley Composite Index. You can go and have a look at the top weighters in there, and you can go and look at the single multiple PE kind of businesses there. Those were, any of those,
and now in South Africa?
We thought were good ideas. Marginal upweight in South Africa, predominantly because the price to earnings ratios are kind of back at their normal kind of levels where they were. Earnings growth last year was up beyond 30%. Are you going to see that again in South Africa this year? Well, let's wait and see. Let's see. I mean, if the PEs drop again to 10, 11, quite frankly, yeah, we become net buyers again of South African equities. So slight buying opportunity here and there.
Okay, so like back to Foord. Would you buy this fund?
I think the risk, if you look at the structure of this portfolio, the exposure, I should say, to the dollar is very high. So the manager here is very much long dollar, short euros in his positioning, because most of the cash is in the US and most of the stocks are also a US exposure. So clearly this manager does not like Europe at all. And if you have
a lot of investors are actually saying the dollar is going to strengthen this year.
Absolutely.
Relative to the euro,
a lot of people are saying that. So if you do believe that, then this fund is certainly giving you a very strong dollar exposure globally.
Cobie.
You know, the other thing that you find is that when you're buying global stock, you've got dually listers often globally. So your big businesses, the titans, are often listed in its home market, but it's listed on the New York Stock Exchange. So when you buy on the New York Stock Exchange, you're just getting all the exposure with it, you're getting all the reporting and absolutely everything with it. And you may be seeing some of that bias coming here as well, coming into as well. And then dollar, euro, well, I don't know, it's a tough choice, you know.
Wait till the end of March.
Fantastic, gentlemen, and then we'll see you soon before the end of March. And of course, we'll be discussing more pertinent issues when it comes to asset management.